Hi, my name's Joe Achituro. I'm a certified public accountant, and I'm going to teach you everything you need to know about finance and investments. So let's get started. So this is going to be a quick video teaching you about interest and compounding interest. Let's start with the dark gray line, right? So let's set up the chart. We have the years. This is going to be a simple compounding interest by years, right? We're going to, with the principal is how much money you start with. We're going to do $1. The interest rate is how much money we earn. Now I picked the S&P 500. The S&P 500 over the last, 50 years or so has generated approximately 9.8% interest. But to make it simple, I lowered it to 9%. So on $1, we multiply that by 9%, we get 9 cents. At the end of the year, we have accumulated our principal plus our interest of 9 cents, which would give us at the end of the year a total of $1.09. Doesn't seem like much. But as we continue, we'll begin to see how this can accumulate. In year 2, that $1.09 comes over here because that's our principal at the start of year 2. Start of year 2, we have $1.09 multiplied by 9% gives us 10 cents instead of 9 cents. We made an extra cent. So now, added together, the 109 plus the 10 cents gives us $1.19. And this will continue to work. The $1.19 goes to year 3. Our money grows at 9%. We make 11 extra cents. So we take the $1.19 plus the 11 cents, and that gets us $1.30. Now, this is just with $1. So over 40 years, that $1 will turn into $28.82. Sorry. On the last year, it will be worth it $31.41. My bad. That's at the end. But that's $1, right? That doesn't mean much. Let's take a quick look at what happens if you invest just 1 year in a Roth IRA. The limitation's $5,500 to invest in a Roth IRA. That money will grow. Now that same 9% turns into an extra $500, right? An extra $495. And let's look what happens after 40 years of that. Every $5,500 you invest in year 1 will turn into $158,000. That's a lot. That's a lot of money. Why is this important? Because the same thing works in reverse. When you waste money on assets that don't go up in value, you're throwing away your future wealth. The future wealthy you doesn't ever get to enjoy retirement because you wasted money on, let's say, a brand new BMW when you got your first job, instead of putting $5,500 in an account and in some stocks that are going to grow at about 9% a year. Where else does this come into play? Well, let's take a quick look. What if I made $100,000 a year, right? That's my income. Let's say I live in a high-tax state, and that state charges me 7% income tax. So income tax rate. And so let's do a quick calculation of 100,000 times the income tax rate, state income tax paid, right? So if I pay $7,000 in year one of income taxes because I chose to live in a high income tax state, let's take a look at how that's going to affect our retirement. Oh my goodness. Simple compounding of interest means for every year I make $100,000 in a high income tax state, my future worth is going to go down by at least $219,000. That's a pretty big deal. That's a pretty big deal. So why is this important? This is important for several reasons. There's a gigantic demographic switch going on currently. This is the year 2019. And there's a big change happening. Technology companies and wealthy people are starting to leave high tax state areas like Massachusetts, Rhode Island, New York, California, and they're starting to move to low state tax areas. Why? Because wealthy people generally understand compound interest and the powers it possesses. So if we take compound interest, and now you're going to multiply this by maybe $1 million, right? Because a really, really wealthy person might get taxed $1 million a year. We'll use 100,000 as an example, or 1,000. Let's use 1,000. So $1,000 is going to be worth 31,000. So $1 million is going to be worth $31 million in 40 years. To create generational wealth, you don't want to live in a high tax state. Because for every $1 million that get taxed, you're costing the future generations of your family $31 million. And that $31 million, let's take that $31 million. And let's see what happens to $31 million for the life of your family. Right? That $31 million is going to generate $2,790,000 a year. That $31 million is going to become $1 billion if it grows and remains untouched for 40 years. Now, it probably won't. But do you think your offspring are going to have a pretty decent life at a 9% interest rate growth? Living in a no-tax state where they get to keep almost all that money? Of course. And this is how families like the Rockefellers managed to stay wealthy generation after generation after generation. Understanding the basics of compound interest is going to help you save enough money for your retirement. This is why you should be upset when politicians say they want to raise taxes. Because even raising taxes on the poorest people, a little bit, $1,000 worth of taxes on anything, a car tax, anything you could have put towards a retirement fund, if you had that $1,000, is going to hurt your future. It's going to hurt the amount of money you have in the future. So every financial decision you make, whether you buy a car or a house, fancy clothes, expensive dinners, every decision you make financially where you're not putting away money because you spent too much on something lavish, when you are younger is going to cost you when you get older and it's time to retire. If you learn nothing else from any of the videos I'm about to put out, learn the basics of compound interest and how they will affect your future. In another part, let's pretend compound, it's not, we can replace this interest rate with inflation. Federal Reserve has a 2% inflation target. Okay? If we change to a 2% inflation target, what happens to a loaf of bread in 40 years? What happens to the price of anything, right? So right now we pay, let's say, $20 for a movie ticket. What will a movie ticket cost in 20 years with 2% continuous inflation? In 40 years, a movie ticket will cost $44. That same movie ticket will cost $44 if it just keeps up with inflation. Right? We can do that with anything. Our house. We spend $200,000 on a house. What should we expect if we rent and we want to buy a house in 10 years? Right? This is year 10. That same house we could have bought today for $200,000 is going to cost us, or should cost us, somewhere in the neighborhood of $243,000 to buy. All else being equal. Okay? Cars. Right? When I graduated, you could get a new car for somewhere in the neighborhood of $13,000. I graduated when I'm 40, so let's say 20 years ago. How much is a new car today? The cheapest new car you can get, right? Cheapest new car you could have got, somewhere about $13,000. If it kept up with inflation, cheapest new car you can get today, pretty much $19,000, isn't it? Go look. Pretty much the cheapest car you can get, somewhere between $17,000 and $19,000. And that's compound interest. That's compound inflation. Because inflation works the same way. It compounds. 2% inflation means at the end of the year, something that cost $1,000 in January should cost $1,020. End of year 2, beginning of year 2, that $1,020 should cost $1,040, right? So after 40 years of inflation at 2%, anything that would have cost $1,000 should now cost you $2,200. This is why it's very important to invest your money in assets that grow above inflation. This basic principle is fundamental to understanding everything in finance. Moving forward, any other classes I put out are based on this very simple principle of compounding interest. Because this calculation is needed to understand everything. It's needed to understand how you pay your loans, when you get a car loan, when you get a house loan, a mortgage. It affects everything. This basic principle affects everything finance related. So if you understand this, you can understand just about anything having to do with finance in the economy over long periods of time. I hope I helped you out. I hope I gave you some basic knowledge that you probably didn't get in high school. And let's face it, you probably didn't get this in college either, unless you took some sort of a finance course. And then this should have been taught to you in basic finance. And that's going to be the end of today's lesson. Thank you once again for watching this video. Don't forget to subscribe. Don't forget to click notifications. On My Free CPA on YouTube, you're going to have a link to myfreecpa.com. On here, I would encourage you to sign up, get yourself an account, because you're going to be able to save all the courses I put that are relevant to you. And you're going to be able to go back and reference them year after year after year. In addition, there's going to be a Do Your Own Taxes link. This is going to be free online tax software if your income is below a certain threshold. It's basically just like TurboTax or H&R Block online taxes, but cheaper, right? This is the professional software I use, put online for individuals. I'm going to be using this software in most of my videos to explain to you how to do your own taxes. So if you want to sign up for this, please use that link. And when you use that link, I get credit, right? If you're going to do a tax return that's going to cost you some money to prepare using the tax software, because again, not all tax software is free depending on your income levels and your other circumstances, I am going to get some credit and get paid for this so I can keep putting up this videos for you. Thanks once again, and have a great day.